Welcome to the IFRS for SMEs technical series. I am Calverwell and I help SMEs apply accounting standards to improve reporting, strengthen compliance, and build credibility with banks, investors, and partners. In this video, part of the Technical Accounting for SMEs series, we are looking at Section 17 of the IFRS for SMEs, Property, Plant, and Equipment. We'll define what counts as PPE, look at recognition and measurement, cover depreciation and impairment, and end with derecognition rules. Property, plant, and equipment are tangible assets that are held for use in production, supply of goods or services, for rental to others, or administrative purposes, and are expected to be used over more than one period. This makes them different from inventories, which are held for resale, and from assets used in producing inventories. This section applies to property, plant, and equipment and investment property where fair value cannot be measured reliably without undue cost or effort. To recognize an item of PPE, it must be probable that future economic benefits will flow to the entity. The cost must be measured reliably. Spare parts, standby, and servicing equipment, if they meet the definition of PPE, they are capitalized. If not, they are inventory. Materiality also matters. Immaterial items may be expensed, but always under a documented capitalization policy. For assets needing major replacement or inspections, the cost of a replacement is added to the carrying amount if it brings future benefits, and the replaced part is derecognized. Inspection costs are treated the same way. Capitalize the new, derecognize the old. Land and buildings must be recognized separately. Why? Because land is not depreciated, but buildings are. Separating them ensures accurate depreciation and residual value estimates. At initial recognition, PPE is measured at cost, which includes purchase price minus discounts, directly attributable costs like site preparation, delivery, installation, and site restoration or dismantling costs. Costs that cannot be capitalized include opening a new facility, advertising, training, administration, and overhead, and borrowing costs. If acquired through deferred payment, use the present value of payments. If acquired by exchange, use fair value, unless it lacks commercial substance, in which case use carrying amount. Two models apply after recognition. Cost model, cost minus accumulated depreciation and impairment. Revaluation model, revalued amounts less depreciation and impairment, but only if fair value can be measured reliably and applied consistently across a class. Depreciation reflects consumption of economic benefits over useful life. And the key points are: major components with different pattern of use are depreciated separately. Depreciation method must reflect consumption, straight line, diminishing balance, or unit of production. Begin depreciation when the asset is available for use. Stop when derecognized. Useful life considers expected usage, wear and tear, obsolescence, and legal limits. Changes in estimates, like useful life or residual value, are treated as changes in accounting estimates, not errors. An item of PPE is derecognized on disposal or when no future economic benefits are expected. The gain or loss is the difference between net disposal proceeds and carrying amount. It must be recognized in profit or loss, not as revenue. Section 17 of the IFRS for SMEs provides the foundation for accounting for property, plant, and equipment. It ensures assets are measured correctly, depreciated appropriately, and derecognized consistently. Stay tuned for the next video in this Technical Accounting for SMEs series, where we'll look at investment property section.